Hello everybody, this is Danny here. Hope you're well. Today we are going to talk about the most important part of trading, the money management. So we discuss what is money management, how to live to trade another day, know what you are willing to risk, how to determine your trade size, stop loss order, trailing stop, and then we come to conclusions of this discussion. So the first thing we are going to talk about today is money management, what it is. Okay? So most important part of investing is money management. Money management involves determining how much of your overall profit you are willing to put at risk in any one trade, and how many contracts or how many lots your risk tolerance allow you to put on. Money management can be the difference between a successful account that you are able to manage far into the future and an unsuccessful account that you decimate in 6 months. You wiped out in 6 months. The trader who enjoy the greatest amount of success in their trading are those traders who have established clearly defined rules that governs their trading. These rules help them to avoid the money management pitfalls. Following are the 3 money management rules you will want to incorporate into your trading. So you have the first one, which is to live and trade another day. Live to trade another day. Know what you are willing to risk, and know how to determine trade size. So these are 3 important rules you must always put in your mind when trading. So let's take the first one for example. So we are going to talk about the 3 one after the other. The first is live to trade another day. So it's perhaps the greatest piece of advice you could receive in your investment. Regardless of whether you are right or wrong in your trading analysis, if you live to trade another day, you know that you will always have another chance to make more money. So the next 2 rules, we are going to show you exactly what you need to do to survive every day in the forex market. But as long as you understand and believe the first rule, you will already have an advantage over most traders. Believe me, the single factor that causes most traders to overextend themselves and blow up their account is greed. When traders get greedy, they take unnecessary risk. They also spend countless number of hours trying to find one technical indicator or one economic announcement that is the holy grail of trading. They believe that if they only follow what that indicator says or what that economic announcement points to, they will never have to worry about being unprofitable in their trading again. They are wrong. To help you to avoid the frustration that always comes from losing in the market, we are going to show you how you can live to trade another day so that no matter what changes take place in the market, you can be successful. So the first way of live to trade another day in the market is you need to know what you are willing to risk. You need to know what you are willing to risk. This rule is the basic tenet of living to trade another day. If you don't risk too much of your account in one trade today, you know you will have enough in your account tomorrow to place another trade. In other words, it is not sound trading practice to put all your money in one trade or 2 trades, because you never know what is going to happen in the market. You don't want to risk everything you have on one position. the first thing you have to do is determine what percentage of your account you are willing to lose in any one trade. Once you decided that, the rest is a simple formula. See, this is the formula. If you have decided, for example, that you want to risk 2% of your account, assuming this is your account balance, so it is account balance divided by risk will give you amount at risk. So account balance is 5,000. For example, you want to risk 2%, so amount at risk is $100. $100. Okay. Most traders feel comfortable risking approximately 2% of their total account balance in any one trade. While this is a general rule of thumb, you will need to determine how aggressive or conservative you want to be in your individual account. If you want to be more aggressive, right, you will risk a larger percentage of your account in one trade. If you want to be more conservative, you will risk a smaller percentage of your account in one trade. It is up to you to determine how much you are willing to risk. But I'll say one thing, avoid going to either extreme. For example, if you want to be more aggressive, consider risking between 2 to 5% in one trade. If you want to be more conservative, consider risking between 1 to 2% in one trade. If you risk too much, you probably won't be around to trade much longer. However, if you risk too little, you may not make much money in your trading. Once you determine the percentage of your account you feel comfortable risking, you are ready to go. So the next rule is how to determine your trade size. So once you know how much you are going to risk, the next is how to determine your trade size. Okay? So you need to know how to determine your trade size to prevent unnecessary exposure to risk. Trade size is the amount of currency you purchase in any one trade. Once you know how much you are willing to risk, you need to know how to set it up so that your trades don't end up risking more than you are comfortable with. It doesn't do you any good to know what your risk tolerance is and then enter a trade that exposes you too much of your account to risk. To determine your trade size, you must first decide where you are going to place your stop loss. We will talk about stop loss very soon. Once you have determined where to place your stop loss, you have to figure out how many pips lie between the point you are going to enter the trade and the point you are placing your stop. So once that is done, all you have to do is to look at the equation to find what your trade size is. So your trade size equals to the amount at risk divided by the stop loss. So let's say you've already calculated that you are risking $100, and then you know that your stop loss is going to be 50 pips. So amount you are risking is $2. 100 divided by 50 will give you $2, and that will be 2 mini lots. You know, a standard lot, one standard lot is $10. One mini lot is $2. One micro lot is 10 cents, and so on and so forth. So for an account capital of $5,000 with a 2% risk tolerance and a 50 pip stop loss, you will be trading only 2 mini lots. Okay? Now let's switch our attention to stop loss orders. So stop loss orders allow you to protect your trading account even when you are not in front of your computer, which is essentially since it is physically impossible for you to watch your trade 24 hours per day. If you buy a currency pair, you place stop loss order somewhere below the current price and protect you in the event the currency pair turns against you. If you sell the currency pair, you place a stop loss order somewhere above the current price to protect you in the event the currency pair turns against you. So let's say you are placing a buy order here, or you bought here, you are in a buy position. Your stop loss order will be just below the buy position. Similarly here, if you have sold or you have a selling position here, your stop loss order will be here, so that if this turns against your position, you will be out with a minimal loss. Here, if you've bought and it turns against you, it's going down, you'll be stopped out with minimal loss. So that is the importance of stop loss order. The other type of stop loss is called the trailing stop. So trailing stop automatically adjusts to the current market price of a stock or of currency. So it provides investor with greater flexibility to profit or limit a loss. So you have a fixed lot, for example, fixed trailing stop. So let's say you have a 10 pip trailing stop. Each time the market moves up in your favor, you move your stop by that amount of pip, 10 pips. Next, you move 10 pips and you follow you trail your position. You have what is called average true range as well, that can help you to trail your position. So we are going to bring to conclusion now. So risk management is the key to survival. Risk management is the key to survival. You can be very skilled trader and still be wiped out by poor risk management. Your number one job is not to make profits, but rather to protect what you have. As your capital gets depleted, as your capital reduced, your ability to trade and make profit is lost. Use stop loss to solve this problem. Okay? Let's talk about greed. Some traders feel they need to squeeze every last pip out of the move. There is so much money to be made in forex market every day. Trying to grab every last pip before the currency pair turns can set you up to lose the profitable trade that you already have. Well, don't be greedy. What is over leveraging? So when a trader chooses a high leverage for their account, that is over leveraging. Avoid it. Over leverage or leveraging can work to your favor and against you, but over leveraging will definitely work against. And finally, trading journal is a history that you keep of all your trading decisions in the past. So why you took a trade, you will write it down. What are your emotions at the time? You will write it down. What was the outcome? You will write it down. Did you make the right choice? Did you decide rightly? So you keep all this history, the record. So that will help you in the future when you are considering entering a position. You will compare it with what you've done before, and you see what you've done correctly. You will improve on that, or you repeat that. But what you've done wrongly, you will change that. That is how you develop as a trader. Okay, everybody, I brought this topic for you to know that it is not just having a technical indicator or a trading strategy that is important. The most important is how to manage the risk involved. I hope you enjoyed this video. I hope you like this video. If you do, share it among your groups on the social media, and you can subscribe as well to get updates from us, and very soon I will bring more videos to you. Thanks for watching. It's Dare.